Gold is often referred to as a safe haven during times of crisis. But how did it actually perform in the most recent recessions that we had? I checked this for you. But before we go on, let me clear the terminology for you. What does actually recession mean? We've been hearing about recession and market crash in the recent weeks. But do you actually know what those terms mean? Let me give you short definitions so that you will be prepared the next time someone is talking with you about depression. The market correction is a case when the market tanks by 10%. We talk about bear market when we have a 20% decline. If the down is by 35% and lasts 3 to 6 months, we can say we have a market crash. We talk about recession when the market crash lasts more than 6 months. And the next term is depression. This means that we have a downturn lasting more than 2 years and the GDP has dropped by at least 10%. Gold is unique, but what makes it so expensive? Gold is a relatively rare metal with lots of versatility. It's highly malleable, meaning it can be deformed or changed without fracturing the material. But what distinguishes it from other useful precious metals is its totally unique bright yellow appearance. Over many centuries, civilizations across the globe became enamored with the beautiful metal, such as the ancient Egyptians. So with all that in mind, it might surprise you to know how little gold there actually is here on Earth. If you melted down the world's entire above ground stock of around 190,000 tons of gold, it would form a 72-foot cube. However, if that was divided up equally for every person on Earth, we'd all get roughly an ounce of pure 24 karat gold each. An ounce equals to 28.35 grams or 1/16 of the pound. There's one last thing you should know before we get to the charts. The gold standard has been a foundation of the monetary policy throughout history. But the United States of America became the last country to stop using the gold standard in 1971. Most European countries went off the gold standard after the First World War in 1914. Now it's time for the charts. Here you see the most recent recession in 2007 and 2009. On the left side is displayed the S&P index, and on the right you see the gold price per ounce during the recession. As you can see, S&P lost 51% of its value, while gold added 16%. Now we move back to the early 2000s recession. It was caused by the collapse of the speculative dot-com bubble and because of the September 11 attacks. As you can see, the S&P index dropped by 25%, and during the same period, gold added 7% to its value. The next recession was the early 1990s. We had several reasons for that. First, the high interest rates and the 1990 oil price shock. As you can see here, the chart again, 19% drop in the S&P index and 5% gain for the gold price. The next recession in retrospective way was the 1981-82 recession. It was caused by the Iranian Revolution, which led to an energy crisis, and because of the tight monetary policy in the United States. This time the chart may surprise you because the S&P dropped by 33% and the gold dropped also by 15%. So this is the first recession where we see the gold price dropping. But there are several reasons for that and I will explain this. Now we move back in time with just 1 year to the 1980 recession. The recession began when the Federal Reserve under Paul Volcker raised interest rates dramatically. This recession and the 1981-82 recession are often referred as a double dip or double shaped recession. You see here we have a 17% drop in the S&P prices and 68% increase in the gold prices. In order to understand the sharp increase of the gold price during the 1980 recession and the drop during the next recession, which began just 2 years later, take a look at the silver prices. As you can see, the silver market was manipulated by the Hunt brothers. The same applied also to the gold market. So this is why we have this extraordinary market situation. And the last recession to be covered with my research is the 1973-1975 recession. It began when OPEC increased the oil price with 400%. The S&P price that you see on the left side was dropped by 44%, and the gold price increased by 70% during this recession. If you like my video and want to see more videos like this, make sure to press the subscribe button. Now I want to finish my analysis with this very simple graph. It shows you what would happen if you would have invested $100 in gold and in S&P exactly 50 years ago in April 1970. So as you can see, you would have today gold, which is worth $4,550 roughly, and the S&P index would be worth $3,500. But of course here I didn't calculate the dividend payments that you would have received in S&P.